Hi, welcome to the Optimum Academy. I'm Lisa Berger, and we'll spend a few minutes together to chat about insurable interest, which is the most basic part of the life insurance contract. At the heart of the policy is a legitimate insurable interest. There needs to be a relationship established with the beneficiary experiencing a financial loss at the insured's early death. It's critical that the beneficiary of the contract is not better off at the early death of the insured. If they're better off at the insured's death, then fraud is very likely. And that's something that we definitely want to avoid. The most common insurable interest is personal. There's also business coverage, and we'll talk about that in another module. But in the personal relationship, the insured and the beneficiary will share something in common, whether it's a financial responsibility such as a joint loan or a mortgage, familiar relationships such as children or care of somebody in the family, or perhaps there's a charity that relies on the insured's regular donations of tithes or talents. So when and why do we look at insurable interest? Well, we do this during the underwriting process. That's when the beneficiary and owner relationship and the financial interest in the insured individual are obtained. This makes sure that the interest exists and that maintains the ethical and financial integrity of the life insurance contracts. We want to prevent situations where individuals might take out policies solely for speculative purposes rather than genuine risk protection. The requirement for insurable interest in life insurance is often a legal and regulatory requirement. And contracts that lack that insurable interest may be deemed void or unenforceable at the death of the insured. So let's review a case study just to look at the considerations for insurable interest. Here we have a 38-year-old female who is self-employed coming in for $200,000 a term with the fiance as the beneficiary. So what do I want to consider in this type of a request? So some of the questions you would be asking yourself is, does the fiance have coverage with her listed as a beneficiary? What's the household income? What's the financial loss to the fiance at her death? What is the value of the joint assets held, and are there children involved? Please recall that a fiance relationship is not a legal status such as marriage is. Just because you're a fiance doesn't mean that you're going to be staying together. We all have heard of those times when the the engagement is broken off. So we don't give it the same status as marriage. So if we continue with this, the rest of the story in this situation is that the applicant recently placed coverage for the benefit of her two minor children at $25,000 each. Her personal income is $65,000. When we asked, no income was given for the fiance. They did advise that no joint assets were held and they had no children together. Also, the fiance does not hold coverage with her as a beneficiary. So there's some red flags in this situation. Why would we cover children at $25,000 but then give a fiance almost 10 times that amount, especially when there's no financial relationship established, there's no joint assets, and no joint children to cover. So this is a situation where we probably don't want to move forward with this. Here's another case study where the owner wants to insure the life of someone he has selected that is younger and in better health than he is. However, he wants to use his own the financials of the person that's not being insured. This is one where there's really no relationship between the owner and the insured, and while they may know each other socially, there's no financial basis for this. This is almost similar to Stoley. So the details are, it's a 60-year-old male. He's clergy. He's coming in for $200,000 of universal life. The owner, and Benny, is a charity. So at this point, it's not looking terrible. His income's $30,000. Net worth is $100,000. However, a payer of this is another clergy member who's 73. He's uninsurable. He states that he has chosen this insured as his proxy for the insurance for the purpose of donation in the charity based on his own personal net worth of $1 million. So if we look at this for the basic tenets of an insurable interest, there's really no financial loss at the insured's death to the person that wants to pay this. and there's really no insurable interest between these two individuals. So proxy insurance fails both criteria for this, and this is one that we would not be able to do. If this was a situation where the payer was not in the picture, then we would look at the clergy's, the insured's personal income and net worth, and make the decision from that point. However, with the proxy type of insurance, that's not something that we would want to continue with. Now, here's a common relationship that we see with the charity as a beneficiary. This case study, we have a 70-year-old female who is looking for $100,000 of universal life. Her income is $100,000. Her net worth is $5 million. She herself is the owner and payer, and the beneficiary is her church. We know that there is coverage in place for her spouse and her family. She states that she plays the organ at church and has, for most of her adult life, tithed $5,000 a year. So a common factor used for charitable beneficiaries in determining the face amount is 10 times the annual gift, or the economic value equivalent to the annual service hours that the insurance provides to the charity. And of course, we always assume that the family has been cared for. So at 10 times her $5,000 annual gift, we can get to $50,000. And with knowing that her time and talents are spent playing the organ at the church, we can overall justify the total amount. So just to wrap up, the insurable interest should be established on each and every file. If the beneficiary would be better off at the insured's death rather than made whole, fraud is likely. So, and always make sure that the arrangement makes sense. That's kind of the basic tenet of any underwriting decision. So thank you for spending some time with me. I look forward to the next module in the Optimum Academy. And if you have any topics that you'd like us to cover, please let us know. We appreciate your time, and thank you very much.